Good afternoon, everyone, and thank you for joining us for webinar number 4 in our succession planning series. This webinar will be recorded for those that were unable to make this live version, and for those of you who might even want to watch it again. We are planning for the webinar to last around 45 to 50 minutes, and due to the number of individuals attending, we will not be taking questions throughout the webinar, but we will have a few polls for you to answer, and we'd really appreciate and be grateful for your responses. If you do have any questions, please use our contact details on the subsequent slides to get in touch. Next slide, please, Daisy. As I mentioned already, this is webinar number 4 in the series. Links for the first 3 webinars that have already taken place are available. These can all be accessed on our website. Please look in the succession section. So number 1 provided an overview on IHT reliefs and succession planning. Number 2 explored IHT and pension planning options. And number 3 covered your options for exiting your business. Thanks, Daisy. So I'm very ably assisted this evening by Brian Harvey, our Head of Agri and Landed Estates, and Mike Butler, one of my fellow partners. Both Mike and Brian are very well known in the farming communities across the Southwest, and they're looking forward to sharing their thoughts and opinions with you. And for those of you that don't know me, I'm Dawn, and I'm a partner in our Agri and Landed Estates teams too. Please do contact any of us after the webinar with any further questions. Our contact details are on the screen now. Thanks, Daisy. So what are we going to cover this evening? I'll be kicking off to talk briefly about what we know, the current release available, and the proposed changes. Brian will then be covering what's at stake, and then Mike will take over to discuss making gifts and a real-life example that he's been working on recently. Thanks, Daisy. And again. So here we are, another rural update where there is uncertainty. Rachel Reeves announced proposed changes to the IHT legislation in her October 2024 budget. Whilst we are not expecting any significant changes to her proposals, they still do not yet form part of legislation. Draft legislation was released on the 21st of July 2025, with no deviations from her original announcements. On the 14th of August 2025, Centax released their report on the impact of the proposed changes. So this is a report that's prepared by academics at LSE and Warwick University, and they use HMRC data to model the impact on farms of the proposed changes. The report is chunky, at almost 140 pages, and our very own Brian Harvey was involved in a number of calls with the Centax team whilst they were drafting the report. As I said, the report is huge, but I'll just highlight a few areas for you that are interesting. They assessed the NFU's suggestion of a clawback of IHT when a farm is sold instead of on a death. They decided it was a non-runner due to the behavioural change that would incur. So, for example, farms wouldn't be sold, they'd just be mortgaged against to release cash and so on. And actually, this hasn't been done anywhere else in the world, so the OBR can't assess the financials with any confidence. The report does go on to suggest some changes. So a minimum share rule, for example, where 60% of the estate and gifts must be relievable assets. An upper limit, and maybe a capping of the relief at 10 million. Making the £1 million allowance transferable, and increasing the 100% allowance to £1.5 million or £2 million from the proposed 1 million. We'll see if Rachel has listened when the autumn budget is released on the 26th of November. But back to her existing proposals. It's important to note that the qualifying criteria for both APR and BPR have not changed. I'll remind you of these in a minute. The change that will impact you are the changes in rates. The APR changes have dominated the headlines. However, the impact of BPR changes are equally, if not more significant, as these changes will impact far more businesses than just farming businesses. Thanks, Daisy. So, as previously mentioned, the qualifying criteria for agricultural property relief is not changing. And as a bit of a recap, it is the relief from IHT on the agricultural value of agricultural property in use for agricultural purposes and owned for at least 2 years when farmed in hand and 7 years when let. There are 2 rates of relief under the current rules. They're mostly at 100%, although one of the exceptions is land let on an old pre-1995 AHA tenancy, where the relief is actually at 50%. APR is available for land in a company where the shareholder has a controlling interest in that company. From April 2025, APR is extended to land used in environmental land management schemes if that land had been used for agriculture for 2 years prior to joining the scheme. And on to business property relief. So business property relief is relief from IHT on business assets. That might be in partnership capital and current accounts, sole trades, or shares in limited companies. The rate of relief is 100% for those businesses that are wholly and mainly trading. You'll all be familiar, I think, with the farmer tests and the Balfour matrix to assess the trading status of a business. Accepted assets in the business don't receive relief, and these could include excessive cash balances and or assets not used in the business or any personal assets that are on the balance sheet. 50% relief is available for assets owned outside a business that are used in the business. It should be noted that BPR isn't available on directors' loan accounts or other loans to companies. Thanks, Daisy. So what's changing? The draft legislation states that the rules will change from April 2026. 100% APR and or BPR relief will only be available on the first £1 million of value. Any value over and above this will only receive 50% relief. The rest will be subject to 40% IHT. This is, as you can understand, a major change. The widely publicised effective 20% IHT rate is reached by multiplying the 40% rate by the 50% relief. Any gifts made after the 30th of October 2024 will fall into the new rules. Those made prior to this date will be under the old rules and will not have any restrictions. Mike will be talking more about gifts later on. It's important to note that the £1 million allowance is not currently transferable between spouses and civil partners. You'll remember that this was a suggestion from the Syntax report that I mentioned earlier. It's hard to imagine this won't happen, as it could quite easily follow the same rules as the nil rate band, which is transferable between spouses and civil partners. The £1 million allowance is refreshed every 10 years, and this is important to note for any gifting strategies that you may want to implement. The new rules also impact relevant property trusts, and the rules change the effective rate of tax on an exit and 10-year charge calculations. From April 2027, pension funds will be subject to IHT and death estates. It should also be noted that APR and BPR assets held within pension funds will no longer qualify for IHT relief. And again, this is quite a major change. We wait with bated breath for the autumn budget on the 26th of November 2025. Now over to Brian. He's going to do some polls with you and discuss what's at stake.
Thank you, Dawn. As you say, we will wait very much with bated breath for the next edition of the budget, and we will see what happens then, and hopefully it will be perhaps less eventful than the previous one. So in terms of polls, I think we have 3 polls today, all very straightforward, very simple questions, and if you can all answer those, please. So yeah, 3 questions. I said not difficult. 1, prior to the budget, did you have an IHT liability? So obviously we're talking about last October's budget. Second question is, post-budget, without doing any planning and talking to anybody, do you believe you now have an IHT liability? And then the third question is, are you planning on taking any action? I appreciate that there are a few professionals on this call, so that these questions might not be relevant for you, but if you are a farmer, rural business, landed estate, landowner, then yeah, if you can answer those questions, then give me a couple of seconds to answer them. So I'm trying to see the answers here. I'm not sure. So I can see. I can see some of the answers. A few more people still voting it. Right. So let's just have a quick look at those answers. So interestingly, oh, why is that changed? Going back to the list again. The first question, prior to the budget, did you have an IHT liability? Surprising, actually, 57% of people thought they did have a liability beforehand, but 37% said they didn't have a liability beforehand. So that's interesting. The next question, post-budget, and interestingly there you can see a massive increase. 85% of the people answering this question think they did have a liability, 7% don't think they have a liability, and 7% aren't quite sure. So maybe we can answer that in due course for those individuals. And finally, and I think this is probably in line with what we're seeing at the moment, of those, I guess, who are putting a plan in place, 13% of those have taken action and the plan is now in place. 40%, the biggest group, have plans in progress, and we would say we'd have quite a lot of clients who are very much in that category. In fact, that percentage is going up as we speak. Another third intend to take action but haven't done so at the moment. So yeah, that's good. And then 10%, I don't intend to take action. That may well be that some of those are the people who don't have an IHT liability, so perhaps don't need to take action. But as you say, overall, a lot of plans in progress, a lot of people intending to make plans, but for the most part, still a lot actually haven't actioned it. Now, whether that's because we haven't got the final details or we were hoping that things might soften. I know there's been a lot of lobbying of the right people, but unfortunately to no reward at the moment. But we shall see what happens in the next few weeks and months as everything goes through Parliament and the House of Lords, whether or not what we see will be what we get. So in terms of, I'm just going to talk a little bit about what's at stake and should we be worried. So if we can, where we're at then, I'll talk through an example in a second. I mean, the IHT changes have impacted many farm businesses. As you can see from that questionnaire there, 85% of people answering here think that they've got a IHT liability as a result of the budget. Those figures grossly are much greater than the HMRC, the Treasury said would be impacted, and that's in line with our thinking. Yep, many farm businesses, the smaller ones, are still fortunate, but the vast majority are now caught by the IHT legislation that comes into place from next April, and that's where we hopefully can come in to help. So this, by way of an example as a starter, so Mike's going to come through in a minute and talk about a detailed example of a real client who we've kind of redacted all the information, but this isn't perhaps the most common example, but this is a no bells, no whistles example. So this is for an unmarried single person who owns the farm but no other assets. And what we're trying to look at here is what the value of the farm is, and 3 different examples, whether that farm is worth £2 million, £5 million, or £10 million. And as Dawn has just spoke through the rules there, there's 100% relief on the first £1 million. There's 50% on anything else that qualifies for agricultural property relief, giving a taxable value after APR for the respective columns. There's a 1-0 rate band, which gives a taxable estate and inheritance tax at 40%. Now, just to set the record straight here, prior to last year's budget, none of those estates had any inheritance tax to pay. So yeah, not one. Even if it was £100 million, if it all qualified for APR, it all got relief. And it's important that each of them now have an inheritance tax bill. And it's quite obvious to see there from those figures there that actually the percentage of inheritance tax to the value of the farm obviously increases as the value of the farm increases. And mathematically that makes sense, because more of the farm only attracts 50% APR as those values go up. But even if you're a £2 million farm, a £70,000 inheritance tax bill once in a generation takes some finding. It's not that and there's also, I think, an implicit understanding there that as the farm gets bigger, they should find it easier to make the tax payments. And I can tell you from some of the accounts that we've seen that bigger isn't almost always best in terms of land ownership and profits. There can be a correlation there, but it's certainly not a given. And for a £10 million farm to have to find 16.7% of their value in inheritance tax once every generation, even if you can spread the tax over 10 years, is still a significant find for every generation. So let's take the next slide, please, Daisy. So just talking about a few particular quirks. So spouse exemption, so husband and wife or a civil partner. I won't say this to the wife, but spouses can add complexity, but also opportunity. So there we go. Assets left to a civil partner or a spouse are exempt from inheritance tax. So that has and remains a useful tax planning, as you can gift away the asset or leave the asset to the spouse. The asset is then inherited by the spouse at uplifted market value, and potentially they can then gift that away with no capital gains tax. And if they survive 7 years, assets that may have qualified or may not have qualified for relief before will be moved on. But we do need to be a bit careful there. The availability, the spouse relief is there, but not every family is the same. And not everyone has perfect relationships, and there are things that you just need to be a bit careful about. In particular, there can be complexities if families have multiple marriages and there are kind of different generations, children from different parents within the families. That can create uncertainty, trust issues across, perhaps maybe say across bloodlines, in terms of if one spouse dies and leaves it to the surviving spouse, there is always concern then that the surviving spouse perhaps does the right things for the children of the person who passed away first. So like I said, there can be a lot of tension there. In addition, if they need to consider the situation, if there's quite a large discrepancy or large age gap between spouses, can that have a bearing in the future? It certainly can. You see examples where a surviving spouse may well get married again, find a new family, and like I said, all of these things do need to be considered. One important point that is often overlooked is that in terms of a spouse making a lifetime gift, the 2-year qualification for APR on a lifetime gift to a spouse doesn't apply if that gift is made during life. So if a gift is made during life, then the moment that asset passes from, let's say, husband to wife, the wife has not taken on any of the previous ownership of the husband, and therefore her qualification for APR starts at that second. So at that second, it does not qualify for APR. It's a big loop. It's a big issue there if she doesn't survive, potentially 2 years if she farms that in-house, or even 7 years if she's new to the business and never had any interest in the business at all prior to that gift. So like I said, there is if the asset is passed on death, then the previous ownership of the previous spouse does take into account, but not here, not if it's in a lifetime gift. So we do need to be careful of that. Also in terms of the surviving spouse, we always need to be also careful of what their income needs are in later life. Who knows how long people are going to live for. So we do need to think about that, particularly if it is their first involvement in the business. We do see quite a few where perhaps one of the spouses isn't in the business, but suddenly inherits a 50% share or a whole business on passing, where the next generation have already been involved, and how the dynamics of that and the potential frictions that can bring about do need to be considered. If we now just move on to talk a little bit about your wills and what that may say. Currently, I suppose the most typical will that we would see is that one that's explained at the top there, where everything is left from the survivor on first death to their spouse, with the exception potentially of any assets that might qualify for, I'm going to say 100% APR or BPR assets, which would be chargeable to beneficiaries on first death. So you may wish to pass them on to the next generation without triggering any inheritance tax. That has been common will planning for a number of years now, but typically perhaps those wills that are most common at the moment are not always working as well under the new proposed rules. So we do need to take on board to this. And it's important that we are not lawyers, and I can see there are some good lawyers on this call, but I guess the overarching point here is that all farmers and all landowners need to get their wills reviewed and reconsidered. There are a few potential problems going forward. Yeah, one of the things and I think there are also some accountants on the webinar today. There are a few obscure tax calculations which could give rise to unexpected liabilities. There are things called grossing up, double grossing up, and I can tell you that that's not double the fun, that's more like 3 times the fun. And also section 39A spreading rules, which to all intents and purposes are very long-standing IHT rules, but other than in complex higher level tax exams, have been largely academic since 1992. They've existed, but no one really has given a monkeys about them. They've not been very relevant when assets have attracted 100% relief. But going forward, the implication of those is that depending on how the will is drafted, in what order assets might be gifted to, who gets what assets, etc. It is critical, because if this is not done correctly, because of those particular rules, that can give rise to inheritance tax liabilities that arise that would otherwise not arise at all, which is obviously a bit of a disaster and an unwelcome surprise, or liabilities potentially arising on the different beneficiaries than what perhaps you expected or intended. So yeah, if suddenly an asset has gone to a beneficiary, but there's a tax charge with that which wasn't expected, then that can create a major problem. So yeah, like I said, it is very important to kind of consider your will. It's the most common thing that we are doing and talking to our clients about at the moment. Even if you don't think you've got an inheritance tax exposure, it's worth double checking that, dotting the I's, crossing the T's, and moving on. Another thing which I've put there at the bottom is skipping generations, or in fact, in one case, 2 generations. And we're seeing a lot of that, because obviously at the moment, one assumes if these rules come in, then these are here to stay for a while. Yeah, and actually, multiple generations paying inheritance tax on the same assets is going to be even more devastated. So perhaps one thing that can be done is to skip a generation or 2. But obviously that is a little bit painful if you're the potential beneficiary. I've worked hard and have waited 50, 60, 70 years. It's a little bit like King Charles, waited a long time to then be told you're not getting your go is sometimes pretty difficult to palate. If we now move on, the one most important thing, I guess, is we can, and in most cases, will try and take actions and talk to avoid an inheritance tax liability. But often the answer is yes, we can improve it, but not always, not in every case. There are certainly some elder statesmen of the community where there isn't a huge amount we can do. And even for those where we can do things, sometimes that might need on making gifts, some good health, some longevity, and perhaps a little bit of luck. And no one is guaranteed 7 years. But if that isn't the case, then and you don't survive, then if there is a tax liability, then we need to consider how that might get paid. So if we just move the next slide there, Daisy. So there is a big potential problem here. And the key bit there is the third bullet point down in terms of rural businesses and farm businesses is the tax affordable? And some studies have suggested that in terms of the rate of tax and the rate of return on the investment in farm businesses, often the answer to that question is simply no, it's not affordable. But who knows? Like I said, we shall see. Actually, some businesses have made some more profits this year. It's been quite a good year for several sectors, obviously not the cereal sector, but some of the others. So hopefully, like I said, that is indicative of better trading times ahead. And like I said, that would be good. Everyone would feel a little bit better at that point in time. But in terms of farming businesses, they are still largely unincorporated businesses that we would deal with. I think approximately 80% of the businesses are either sole traders or partnerships with no more than 20%, and it may not be as high as that, as forming through companies. So mainly unincorporated entities, but often I guess those businesses perhaps with the biggest funds or the biggest assets may well be incorporated. So we do need to keep that in mind. It is perhaps potentially, so if we are going to have an inheritance tax bill, the likelihood is you're going to have to take some money out of the business to pay that tax. Now, if you are dealing with a partnership, in principle, the capital and current accounts of the balances of the business have all been bought and paid for in terms of a tax perspective. So it should be relatively easy to take the money out if the money is in the business. Once again, this does probably inherently assume that these are family businesses, but there are partnerships out there who are not families, and there are also partnerships out there where they are families, but they don't particularly all get on, and perhaps haven't all benefited from the wills in the same way, and some might have a tax bill and others don't in terms of inheritance tax. So it's complex and it needs to be thought about. In a company, it's even more complicated, because essentially, at that point in time, if you are looking to get money out of the business, and most of the time the inheritance tax liability is a personal liability of the beneficiary, not a liability of the company, and you've inherited perhaps some shares in a company, then how are you going to get the money out of the asset, out of the business, if that's where the cash is? So you might have to even sell some assets, and if that's inside the business, there's potentially capital gains tax to be paid on selling those assets to get some cash to pay the tax. If there is a dividend, if you're trying to own shares in a company and you're trying to pay a dividend, then probably the dividend rate is around about 39.3% tax to take a dividend or declare a dividend in that company, and then you're going to take that dividend out to pay the tax. So that gives an effective rate of 66%, so needs some planning. And in particular, as I said earlier, that might be just about palatable if you're the only shareholder or you're just the family shareholders in the business. But if there is someone else in that business who owns the same class of shares and really they do not want from that company, that is where we get to. So there we go. My slides have just gone blank, which is not what I was after. My screen's gone, but here we go. Options for settling the tax. Yes, I said maybe the tax liability might be due from whether that be the executors or the recipient of a lifetime gift. And this is something that's perhaps not always well understood. So in principle, if the estate is paid on death, then it's the executor's responsibility to make the payment for the tax as it falls due. But if there has been a lifetime gift, then the tax on that asset is payable by the beneficiary of those gifts. So that's an important point to note. So we're doing a lot of lifetime gifts, and many of those assets may be going to family members, but that kind of farming family members, but also non-farming members of the family. And should you pass an asset on to one of those children, then any inheritance tax may be borne by them. So that certainly needs some consideration, because often that hasn't been properly considered, and who is paying the tax. I mean, you could argue that, I can see some specific examples where non-farming assets are designated to go to the non-farming children. Well, if that's the only asset that we've got that's liquid and can be used to pay the tax, that's fine, but that has major financial implications on the estate, on the beneficiaries who are non-family family. So that has an important point. The other bit there that's worth mentioning here is 10-year interest-free installments. There has been a lot of talk about that. And if the assets qualify for agricultural property relief or business property relief, then you are able to essentially borrow your tax from the revenue interest-free and pay that tax over 10 years. So that is helpful, but it is still a loan that needs to be repaid. If you miss your installments, then that applies pressure to the business. If the asset is a property asset, but not one that qualifies for APR or BPR, then it's still, you're able to pay over 10 years, but it's not interest free. It's very much interest is charged. And if it's not anything to do with property or APR, BPR, then any IHT has to be paid within 6 months of passing. There are also some little bits there about how you might be able to remove funds from a company in perhaps a more tax efficient way. So whether that be purchase of own shares from the estate, buying out of shares, redeemable shares. That's something that John Endicott talked about quite a lot in the first webinar in this series. So if you are interested in that, have a company, then do talk to us about that, because plans need to be placed afoot right now to plan how the tax might be payable in the future. Next slide, please. So this is my last slide for now. Trust. So we're not covering trust per se in this webinar tonight. As I said, that was also covered in the previous one, but trusts are an essential part of the planning that we're doing for many at the moment. Working to a tight time frame, as if you are transferring assets into trust, I think it's safe to say that needs to be done by at least the 5th of April 2026. Hopefully Rachel Reeves won't put a spanner in the works that needs that done before then. However, this is slide particularly is looking at 10-year charges. And what I will say there is, so similar to the previous slide a few back there, we've got this is where assets have already been transferred into trust for £2 million, £5 million, or £10 million. So similar APR, similar net nil rate bands, so the same, some 10-year charge tax at 6% being payable there. Clearly, what the important point here that needs to be taken into account is we would see and have seen several people who would have historically transferred assets that would qualify for APR or BPR into trust. Seeming very smart at the time, and probably still looks quite a smart thing to have done. But if that is bare land or property or buildings that have gone into the trust, such that the only assets that are in the trust today are those illiquid hard assets of land or buildings, and that at 10 years there is a tax charge to be paid, then we have to think about how and where the money will come from to pay that tax in due course. I said £11,000 might be doable, but like I said, there are some figures there, and we need to think about whether or not it's the best thing to perhaps break a trust, and let's certainly have lots of conversations about that. So it is a key issue. There are some transitional rules as well, but overall, you must remember that putting assets into trust might work, but there will be 10-year charges that do need to be considered, and also potentially exit charges after the first set of 10 years as well. So like I said, trust, certainly something for another day, but if you've got any questions on that, do come back to us. And without further ado, I think I'm handing over to Mike, who's going to talk a bit about gifting and work through a specific example. So over to you, Mike.
Thank you, Brian. Well, a lot of detail there. And you can imagine when we sit down in front of our farming clients, it is very difficult to try and express the technical aspects, whilst at the same time, a lot of people are very emotional about the challenges. And of course, the first step is to identify the liability. And then it's trying to do your best to actually explain to them what is possible. And of course, we shouldn't really have to be doing this. That's the point. This is a new world that was thrust upon us on the 30th of October last year. And it is a shock to people, and they're slowly coming to terms with that shock. Some of them are only just realizing the exposure. And as Brian's already alluded to, the 5th of April next year is now very close. Sadly, we have lost some clients in the current tax year. And whilst it's desperately sad when that happens, of course, we're still enjoying, if that's the right phrase, the benefit of the reliefs that we've been used to. And as Dawn alluded to, it's not so much that the reliefs have changed in terms of their nature, it's the amount of relief that you can get. So this is the key thing. And people say to us, what should we do? Which is a very difficult question because, of course, every decision is personal, and every time we talk to clients, it's about what do they want to do when they're furnished with the facts. And I'm sure many professionals on this call find it a real challenge, because people say, well, what should I do? And there seem to be several options, which sounds generous until you work out what those options are. The options of doing nothing and hoping to outlive this government, well, I'll leave you to decide that. But of course, outliving the government also requires some sort of change in the tax legislation back to a more benign and generous system. The other option, which Brian will come on and talk about, is life cover. So I'm not going to do anything, but I will insure myself for the next 10 or 20 years, such that if I do die, there will be insurance to pay the tax if it's due. And that gives you a lot of flexibility, but of course comes at a cost. The other option is to say, well, perhaps my beneficiaries will do very well, and I just don't want the hassle or the worry. And if there is tax to pay, particularly when a husband and wife, the second of them dies, they might choose to say, well, so be it. And, some assets will need to be sold. Everything's gone up fabulously. And of course, that's part of the challenge, that everything is worth that much more, certainly when compared with the previous era, when inheritance tax was high. Of course, the one thing then, land was worth a lot less, whereas now it still seems to be, I'll say, stubbornly high values. Now, of course, the final solution that most people talk about is the possibility of making a gift. And of course, with that comes the jeopardy, the double jeopardy of having to survive 7 years, typically for inheritance tax, for that gift to be outside of an individual's estate. So it's not an instant fix. And the second thing is, of course, if you make a gift of assets to family members, you have to consider capital gains tax because they're so-called connected. If we're talking about land, property, buildings, shares in companies, because their value will stand typically at quite significant capital gains. If you gift those assets to a family member, you have to treat them as if you disposed of them at market value for capital gains tax purposes. And that is a real challenge because, of course, even if you can bypass the immediate capital gains tax issue, you use something called holdover relief. It means that the recipient of that asset takes on that asset at the same low base cost as the donor. That might seem fine if, of course, you are not intending to sell the asset, you're not intending to sell the land that your parents give you. Except what if you had to sell that land because mum or dad didn't survive the 7 years required for a gift and you were forced to sell some of that land? So not only are you paying the inheritance tax bill based on that gift, but because you took on that land at a low base cost, you're also paying the capital gains tax. That is a real double whammy, I suppose is the phrase. And it's something that you need to be aware of when gifts are made in one's lifetime. And perhaps when Brian comes to talk about insurance, it will put some balance on the cost of the insurance. So if the insurance will pay the tax on a lifetime gift rather than sell an asset, which itself could trigger that capital gains tax charge I mentioned, you might find that the life cover, the insurance for that gift period seems all the more affordable. So Daisy, move on to the next slide, please, Daisy. So, of course, I mentioned about 7 years making gifts fall outside one's estate, but everyone says, oh, well, that's not quite right, Mike, because after 3 years, the tax starts to decrease. And that is true. The tax does start to decrease after the 3rd year of survival. And you can see it's the tax that becomes payable if you don't quite make the 7 years that decreases. So this is the tax on the gift when the gift is made. Now, we'll see from the example that the issue is that the 100% agricultural or business property relief, the sort of real juicy cherry 100% band, is used chronologically. And so it's absorbed by earlier gifts first, rather than the death estate, what someone has on death. And so often you might find that reasonably sizable gifts in one's lifetime actually aren't exposed to that much tax. But what it is doing is effectively using up or burning up that £1 million 100% band. And so the benefit of tapering may not be so great unless you get to really quite large gifts, and particularly gifts for an individual that are in excess of 1.65 million. So that's gifts of business assets. So you've got to make quite large gifts if you're going to start to see any benefit after the first 3 years. And so we'll have a look at that in the example, which I'll show in a moment. The other thing everyone thinks about or then often forgets, so some think about it, some forget, is this idea of gift with reservation of benefit. So of course, it's very easy to give things away on paper. Often that can involve also putting assets into trust, to protect the assets. So we won't go into the detail of that. But what you have to do is suffer some financial consequence of that. You can't just gift it away on paper and just carry on exactly as you are. You have to, for example, give up some income if you're giving up interest in land. So that might be connected to the partnership profit share if you're a partner. It's particularly relevant if you start looking at gifts of interest in property where you might live, where otherwise you'll have to pay a market rent to stay living in that house, or otherwise, if you don't, the gift will be ignored for inheritance tax purposes and defeat the whole purpose. And you have to make sure that you don't just simply navigate it round. So you say, well, we've typically had dividends on some shares, but we've given away a lot of our shares, but now we're suddenly going to pay ourselves £250,000 a year salary. If it's not commercial, the tax man is likely to attack it. And you have to think, what will it be like in the new world, as I'll call it, the new dark world, as opposed to the world we've had in the past, where everything's been rather benign. And in a lot of cases, the tax man, if I can call it that, that's probably the wrong terminology nowadays, the HM Revenue and Customs have probably not been so interested in a lot of business estates because of the 100% unlimited relief that's available. But now they are going to be looking at pretty much everything because there's tax to be had. Larger estates over £1 million, tax to be had. Valuations argue the value up because there's tax to be had. Unusual arrangements that perhaps aren't robust, tax to be had. And certainly any professional on this call is going to be minded to make sure that everything they do, which is quite intense at the moment, is backed up by sort of logic and paperwork, because unfortunately it's the professionals here to help people, but it's when this comes to be tested, when people die, that it's going to really sort of test how solid the advice was. So next slide, Daisy. We'll keep moving because you'll all need your tea before long. So we're just going to have a look here. This is an example of someone who makes a gift in the current tax year 25-26. This is shares, actually, value of shares, and it's APR qualifying shares in a company worth 5 million. So in the current tax year, if you were to die, you get the full 100% relief. So it's obviously on the 6th of April 26, we start to then get the impact of the reduced relief. And you can see that the APR is now restricted to 3 million. So the first million at 100% and the remaining 4 million at 50%. So that's 2 million, 2 plus 1, 3 million. And you can see that you're then left with 2 million taxed at 40%, 800. We now get to year 3 and it starts to step down. So it drops by the tapering. The tax starts to taper down as we go into year 4, 5, 6, and 7. And beyond 7, in that example, obviously you wouldn't look back and the tax would be nil. Now, this is a gift and doesn't take into account the tax that would remain still payable on assets that are retained, i.e. not the ones gifted. And so when we look at the example in a moment, that has assets that are gifted, but also assets that are retained. Because logically, one of the things you want to do is after year 7, still have at least £1 million of qualifying business assets in your estate, because the individual, after the 7th anniversary, will effectively regain their £1 million 100% ban. So we'll go to the next slide, Daisy, thanks. There we are. So capital gains tax, not going to say a great deal on that other than holdover relief. That's the key point in there. So holdover relief is typically available where you have shares in a trading company or you have agricultural property. So we're talking about capital gains tax applying especially to land and buildings and shares in companies. Now, if you've got companies, a lot of people find it fashionable to have companies, but if you have companies that own assets that aren't entirely used for trading, typically farming in our world, but you might have assets in that company that generate rental income, then there can be, and there often is, restrictions on how much of the gain you can hold over when you give shares. This is not linked to the more than 50%, what we call Holy or Maney test, which is the test as to whether those shares qualify for the inheritance tax relief, business property relief. There is 2 parts to it. One is an 80-20 test, so the company has to effectively be 80% trading, a far higher hurdle. But also, even then, there is a restriction on the holdover relief, where a significant proportion of the value of a company is relating to investment activity, including rental property. Now, that could be a real issue in farming, where, for example, businesses run through companies, particularly if the companies own the assets in question that generate the rental income. They want to give the shares and they assume that holdover relief is available, and it's not. Another interesting one it is quite a technical point, is whether holdover relief is available if you've perhaps changed the use of an asset during the period of ownership. And at what point can you still get the relief based on the latter use? So if you, for example, you had land that or buildings that have been rented out, but you brought them back into farming, you might say, well, at the point at which I give them their farming assets, but you have to look at the use of the asset through the whole period of ownership of the donor. So technical point there, but because the taxman or the Asian Revenue Customs Officer is going to have the opportunity to smell tax, and you can imagine that our Chancellor, with the state of our economy, is certainly going to charge HM Revenue and Customs with the task of maximising the tax collection. And I'm afraid to say it's perhaps the smaller, the weaker taxpayer that will be exposed to this this scrutiny. I won't talk about overseas individuals. These slides are arranged from another talk, so do look back at those talks. So next slide, Daisy. Because a real life example, so there's no names in here, and so we'll just have a look through. So this is a typical example, husband and wife in a farming partnership. Now, straight away, husband owns the farm, 600 acres owned by the husband, 100% outside of the partnership. And it has, that should say, 400,000 of land-related debt loan, so land-related debt. We've had to translate these slides from Excel to PowerPoint. And you can see down there on this, in the bold letters, a rough valuation that's been put on the asset. So the land at £10,000 an acre, some farm buildings, 600,000, couple of let cottages, remember that one. So you see they sit under the business property relief column. And then we got the farmhouse, the dear old farmhouse. Now you can see that there's an element of that under non-qualifying. So farmhouses can qualify for agricultural property relief, but depending on whether there's a difference between the agricultural value of the house and its open market value, that stems back to a case, the Antrobus case, where agricultural property relief only applies to the agricultural value of an asset. So in exactly the same way as if you've got land that's got hope value, maybe it's worth 20 or 30,000 pounds an acre, only the agricultural value attracts agricultural property relief. Same with a farmhouse. In the Antrobus case, only 70% of the open market value of the farmhouse, in that case, Cook Hill Priory, was to be treated as qualifying for agricultural property relief. So in my example, 30% is not attracting any relief. Now we've got some cows. Look at the cows. Well, they're in 300 cows. So they're in £1,800 a head. You might say, well, they're on the herd basis. What's that all about? Well, of course, for inheritance tax, we have to value things at market value. Same with the young stock, same with the growing crops, same with the machinery. Now, you know, any valuers on this call, I'm afraid to say you're going to be very busy. Hopefully you get paid, but you know, the taxman, HM Revenue and Customs, is going to want everything valued every time someone dies, and there is a potential for inheritance tax to be paid, and the spotlight's going to be on us all, whether it's the solicitor, the accountant, or the valuer, to try and manage those valuations as low as possible, because of course, as Dawn has alluded to, once you get beyond that £1 million threshold, you're into an effective inheritance tax rate of 20 pence in the pound, 20%. So in my example here, we got the debt down below, we got a bit of overdraft, the loan I talked about above to do with the land, so that's what's in the APR column, and then we got the hire purchase as well. We got a bit of asset finance. And you can see that the assets are split between those assets that qualify for agricultural property relief, APR, those that qualify for BPR, and then those elements that there's no relief at all. And you can see that the husband in this example, because he is the one that owns the farm, and assuming that he's not going to simply leave it to his wife and then leave her with the problem, you can see that he has, husband line, 7.88 million of the 8.76 million, and the dear wife has 880,000, mainly in her 50% interest in the working capital. So Daisy goes on to the next slide, and we remember that the dear old husband is loaded up. In the new world, you can see that under his column, if we work down the example, the middle of the page shows you the reliefs coming in. So husband, £1 million of agricultural property relief at 100%. That's the key. The remainder of the agricultural property relief qualifying assets, 50% relief. So that's 5.76 million, half of that, 2.88. And then he gets 50% relief on the business property relief qualifying assets, normally done in that order, APR before BPR. 3.56 taxable, less his nil rate ban. That's the amount that everyone normally has. Now, remember, of course, that that could be used up elsewhere. It could be used up on cash or investments. So in our example, we've got it free and available. 3.235 million. So father has, unless he doesn't use spouse exemption and merely push the problem onto his wife, a tax bill 1.294 million. So at that point, the kettle goes on in the meeting and we have to think about what else we can do. And obviously the wife is a particularly useful opportunity here. I shouldn't say it, could be the other way around, of course. So we go on to the next slide. Now, here we have an example where the husband has, in this very same scenario, introduced the land into the partnership, and he has then gifted an element of that land to his wife, and he's also gifted an element into a trust he forms. His wife, who has been a partner in the partnership, albeit not owning any of the land for at least 7 years, she has the ability to then, having received half of the land, set up a trust herself. And then the son, the lines aren't quite lined up, but the son himself also gets a share of the land. They all actually have 20% each of the land, 1/5. So after the event, husband and wife have 20% each. Husband's trust has 20% each, or has 20%, wife's trust has 20%, and son has 20%. The only reason why the husband and the wife look a bit higher is they do retain complete ownership of the farmhouse. And you can see that the no relief column, the 240,000, is the bit that we don't get relief on the farmhouse. The other example here, or in this example, mum and dad also gift half of their current account, half of their working capital to the son who comes into the partnership. So here we have a situation where father introduces the land to the partnership. He then shares it jointly with his wife, and husband and wife, who then have 50%, then go and make gifts. They put between them 20% in. Husband puts 20% into a trust, wife puts 20% into a trust, and the son ends up with 20%, and they also gift him half of the working capital. So at that point, the 7-year clock is running. So if we go to the next slide, wow, this is good stuff. So we're now on to the second cup of tea in the meeting. If we're lucky, the cake has come out, because we need a bit of energy. I don't need any cake, but we then think, what's the tax going to be? So we're imagining after 7 years, here we go. There's those very same share of assets. You can look down through the numbers, but you can see that, excuse me, you can see that the business interests are that much lower per individual, or with a couple of trusts in there. And I'll come back to the trusts in a moment. You can see that each of those entities have £1 million allowance, including the trusts. And we will, I'll just talk in a moment. The trusts are looked at every 10 years, but the draft tax legislation, the draft finance bill, indicates that trusts will, certainly for at least one trust or a number of trusts, will share £1 million of 100% allowance where they're created after last year's budget. Now that's quite powerful, because you're sheltering £1 million odd of assets on top of what mum and dad have. So although trusts sound complicated, they also bring great benefit. If you think otherwise, £1 million of assets sat on mum and dad's estate, sat on the top of their estate, an effective inheritance tax rate of 20%, that's £200,000 each. So just looking down through dad as an example, there we are. We got £1 million at 100%. Then we get some APR at 50% and some BPR at 50%. That's reduced now because he's obviously given away half of his working capital. 600,000 taxable, 325 nil rate band, and also he gets an element of residential nil rate band. Although his estate isn't under 2 million, there is still an element of residential nil rate band. The maximum of that is 175,000. In this case, it's 120,000, which coincides with the bit that doesn't get APR on the house. So father in that case ends up with 155,000 taxable at 40%, £62,000. And of course, mum, because she is effectively mirroring dad, same tax liability. So if you remember those two liabilities, that's 124,000 as opposed to the previous slide. You might be able to go back, Daisy, a couple of slides, 2 slides even. You're in control. There we are. 1.294. So we're about 1.23. So 1.23 million saved. So if we go forward again, 1.23 million saved. Now you'll see, actually just pop that one. Sorry, Daisy. This is exciting. This is just back one. There we are. You'll see that the son does have 94,000 of tax liability, but the son, of course, being younger, is hopefully not going to fall off the perch too quickly. But if he was any concern over that, because he's younger, he too can take out some life cover, possibly more cost effectively. But you'll see that son is not so loaded up. He's got a massive tax bill because 20% interest are in these two trusts, 20% each in the mum and dad trust. And you can see if you work down those figures, because those trusts benefit from not only the £1 million at 100%, 50% relief on the excess, but also when they're tested every 10 years, they have the availability of the nil rate band, 325,000. So they have nothing to pay tax on every 10 years. Now, of course, the value of the land may go up, but we're led to believe with the draft legislation that the £1 million will index from 2030. Whether that happens, time will tell. So you can see that those trusts are carving out nearly 2.5 million of value that might otherwise be sat on the son's estate. And remember, he would otherwise be paying an effective tax rate of 20%. That's saving him £500,000. So quite a powerful opportunity. But of course, mum and dad also may prefer this scenario because during their lifetime, they, for example, could be the trustees of the two trusts. So whilst they're alive, they may also like the protection that this affords. Now, there are certain nuances. You might say a trust being part of a partnership has an added complexity. It affects the ability to claim the 100% tax relief on plant and equipment, which is a timing issue. But I would suggest that, protecting assets is everything that everyone talks about in terms of succession. And so this is just one scenario that this particular family wanted to enjoy. And in fact, the son didn't want the pressure of having received 60% of the land. He's only getting 20% of the land, and the other two slugs of 20% have ended up in trust. So if we just go forward, I'm going to go forward. On this slide here, so that's the assets that's been moved, 1.295 million. What you'll see here, however, is that this is the taper, the bit at the bottom. This is the point I was saying, in that the £1 million 100% band is used against gifts chronologically. So the exposure of mum and dad, if they were to both die within that 7-year period, is not so great. It's the residue of their estate that would not have the benefit of that 100% band until they've hit the 7 years. So you can see the retained line in the example down the bottom. The retained line sits quite heavily up there at 928 until after the 7th anniversary. It drops down to 310,000 and then drops down further again. So the important point there, if you look at the next slide in a graph form, or go forward one more, that's it, Daisy. They'll all be getting fed up with me. You can see that mum and dad's liability Yeah, you can see where it dropped from the 1.264 million when it was just dad, slightly below when it's mum and dad, because she had a little bit of her £1 million left. Remember, she, in my original example, was only at 880. You can see now it starts to slowly taper, but the taper's not that great. That's the green bit. It's when you get across to the actual 7th anniversary that the liability drops down quite significantly. And it's important that you model this, because this is exactly what you need to know for life cover, so that you don't misconstrue how much the benefit of tapering is. Now, that's 20 minutes or whatever it is. Apologies if I've gone on slightly too long. This sort of thing takes place after 2 or 3 meetings, a lot of thought and consideration, practicalities, talking to the bank, talking to the family. But you can see that when people want to make lifetime gifts, the use of trust to try and protect the assets, but also understanding how quickly the tax falls away or not, as the case may be, the chronological order of the relief supply, it all has an impact on what the final decision is. And to try and explain it to people is incredibly difficult, but it's important that they see the benefit of what you're trying to do. So that's an example that is about to go live probably in the next 2 weeks. And interestingly, the bank have been very embracing of it, because they appreciate that a client that is managing their liabilities down means that there's going to be less risk on the assets, and therefore their security is more preserved. That's an aspect we haven't seen yet, where banks actually start to concern themselves that what happens if someone has to sell assets to pay inheritance tax when they're already quite geared and there's quite a lot of security. No one's really talked about that. So what you don't want to do is have to sell assets to pay the inheritance tax and possibly the capital gains tax as well, and to sell assets because the bank wants some of their debt reduced because you're selling assets to pay inheritance tax. The snowball effect could be considerable. And that's probably a good point to hand over to Brian now, who's going to talk about life cover and insurance as a way of also protecting assets. Thanks.
Thank you, Mike. Entertaining as usual, and clearly huge amounts to think about. We've had lots and lots of conversations like that. Some are not as complicated as that, some are more complicated than that, but I said that it's only by talking about it and understanding where we are that we can start crafting a plan, and hopefully, I said, yeah, that 7-year survival is often key, and this is where potentially insurance or life insurance might come in. And I said, I am aware that, I said, time is time, but I said, numbers are still holding up pretty well. So thank you for continuing to bear with us. In terms of, there has been a previous webinar, which James Phillips, one of our team from Francis Clark Financial Planning, was the key speaker, who talked quite a lot in depth about insurance and in terms of that and inheritance tax. But in terms of insurance, potentially a way of protecting the assets that is an alternative to or goes alongside lifetime gifts is one of life insurance. And we're certainly having a lot more queries and questions about what we can do or should be doing in relation to that. So in terms of life insurance, there's probably 3 different options there. There's a lovely Latin term there, inter vivos, probably should be in italics technically, but there we go. I think that means during life. So that's the type of policy that where the amount insured reduces over 7 years with the liability. So that's where that slide they had before, where it says this is what the liability is after year 1, 2, 3, 4, 5, 6, 7. So the life insurance fades over time, and after 7 years, you hope that you've paid some life insurance policies, but no inheritance tax. That's that one for. Then there's term insurance, so that's for a fixed period of time. Normally, so we'll be able to quote you for some life insurance for a period of time, say 10 years at a particular premium. At the end of that 10 years, potentially, or almost certainly, either the price will go up or the level of cover will reduce, but that does give you a window of opportunity to make some gifts, survive the period, and hopefully by the end of 10 years, your inheritance tax exposure is greatly reduced. And the third one, which we're also seeing quite a lot of, which is very valuable if you've got the pockets to be able to keep paying the insurance policy, is a whole of life insurance policy. And what that means is it will guarantee to pay out an amount for a guaranteed premium. And ultimately, in the majority of those cases, unless you live to being about 120, the amount that's paid out will be greater than the amount that you've paid into the scheme. If you do need talk about that, that can be very valuable, but clearly the whole point of that is you need to keep going forever and ever and ever, because the moment you stop paying into that policy, there is no payout, and at that point in time, it's pure profit for the life insurance company. So I appreciate we have a financial planning team, and it is very much important that in terms of getting some life insurance that can essentially, if it's written in trust, can be paid out to your beneficiaries, that will help assist, maybe completely pay for an inheritance tax exposure, can be very helpful, and particularly helpful if there are assets that are going to some family farming members, some non-family farming members, and making sure that kind of the overall position can be managed, and just looking at managing the risks, because let's say it's quite easy to say, well, there's now some inheritance tax to be paid on the family farming assets. We've always had a lump sum in ISAs and investments, etc. That could be used to pay the tax, but if that sum was due to go to the non-farming member of the family, it doesn't seem quite fair. And I said, in terms of most people want to make sure that their kind of family are thought about, and kind of just make sure that how those policies are funded, and that's an important bit. As I said earlier, the recipient of a gift is liable to the tax. And what is another point which I think we need to be very aware of is in bold there at the bottom, is what are the receiving generation's exposure. So we see many cases where potentially the elder generation are now putting plans in place, and that's great. But at some point in time, the next generation will inherit. And at that point in time, the moment they inherit, they potentially have as big, if not a bigger inheritance tax exposure than their parents did if they'd already owned something beforehand. So particularly that second generation, probably those people in the, 40 to 60 age group category, perhaps a life insurance policy is something that they need to be thinking about sooner rather than later, because typically those insurance policies do not get cheaper as you get older. Invariably, they get quite a bit more expensive, particularly if you have some health issues. So in terms of I think the final slide, Daisy, everyone be pleased with that. How to respond to the new rules. I think there are some tougher times ahead. Hopefully, hopefully think we've reached the peak, but I did just see on the BBC website that Rachel Reeves in Liverpool at the Labour Party conference has, to quote what it says on the BBC website, Reeves warns of harder choices to come as she hints at tax rises, which is very encouraging once again with the November budget, and with the triple lock in place. We will see, but hopefully, as I said, something to kind of very much keep your eye on. But I think hopefully what everyone will see today is that people need a strategy, and there is certainly a balance to be struck, and that probably involves various different things. There is not one size fits all. I think that probably sums it up. It's very hard to generalize, and what might be right for one family might not be right for another, and it is essential that you get bespoke advice from a team of advisors. So typically, hopefully that's us as your accountants, but a good solicitor, a good land agent, obviously a banker who understands and listens. I mean, that can be one of the issues that we see. I mean, hopefully, as Mike said, this should be proactive, and being proactive should help. But if there are securities in place and you're looking to make gifts, that can slow the process up. And if land isn't registered and things like that, and you're looking to transfer it away, so just kind of try and get your ducks in the line as soon as possible, because as you know, with the blink of an eye, we will be at the end of November for the budget, and with the blink of the second eye, will be in April. And like I said, time is time, and like I said, there are certain things that we will still be able to do post 5th of April 2026, but there are other things which, if we do it, perhaps some of the options that are available today will not be available then. So I said, do that. I mean, just though, in terms of very finally wrapping up, do want to use this opportunity to thank Mike and Dawn for giving up their evening to present to us tonight. Very much appreciate that. Obviously, we've got a great team here at Francis Clark. Another couple of partners, Martin Rossiter and Justin Glidden, who are not able to present this evening as well, but also a senior team of directors, managers, and the likes, who we wouldn't be able to do it without the support of our team, who we've had a lot on in the last 6 to 8 months, as you can appreciate. Also want to take this opportunity to thank Daisy, who is on the call here. Daisy has been our master of the slides, but also our marketing head, and has put a huge amount of effort into all of our marketing that we do, whether that be these webinars or upcoming seminars and the like. I did want to say that we are actually doing a series of seminars across the Southwest on the 21st and 22nd of October with the CLA. So do feel free to join us for that. And obviously the webinars that we've done, whether it be the previous 3 or this one, will be online for you to watch again, or kind of just clips if there are particular bits that you want to listen to. And there will also be, and I'm not sure exactly what format it will be, but I suspect there will be budget seminars or webinars that will follow the budget, which will be held, the budget's here late November, so these webinars are like to be early December. And if there is a need for a rural one, because Rachel has implicated the farming community as she did last year and as we did last year, there will be, we'll watch this space. But like I said, we'll be, hopefully that we've kind of said we will do what we need to do. But thank you for listening, and if there is anything that any of us can be able to assist you with, then you know where we are. Thank you very much.